Everyone. My name is Sahil Patel. I am an associate at Anjawala and Khan Advocates. I'm here to take you through part one of the Islamic finance training. This training is part of a four-part series that is structured as follows. Part one is this introduction and an overview of the key contracts. Part two covers Murabaha transactions. Part three covers Musharaka transactions. And part four covers the application of Islamic finances and challenges that we're facing. So to get started, Islamic finance industry started modestly as a niche market in the 1950s and 1960s and has grown significantly into a multi-billion-dollar industry with a huge impact globally. The growth can be attributed to growing demand for alternative mode of finance that widens the choice of investors and governments that have proactively created the enabling environment to promote the diversification of their financial markets. The global financial crisis of 2007 and 2008 exposed the vulnerabilities of relentless capitalistic tendencies that puts the pursuit of profit at all cost above all other social and ethical concerns. This created room for consideration for Islamic finance as an alternative and viable financing model that is not fraught with risk. The rapid growth in the global Islamic finance industry can only be sustained and remain stable if the underlying products are properly structured and if the financial institutions that deploy them know how to protect themselves from and mitigate risk. Investors in Asia and the Middle East have seen the investment opportunities that Kenya can offer. There are already a fair number of corporates from these regions with investments in Kenya. But with the development of Sharia-compliant funds structuring, investments from this region will be attracted more in Kenya. Our banking and financial regulators must also develop regulations that are well anchored to safeguard the interest of customers and depositors alike, ensure the stability of financial systems, promote fair competition for efficient and reliable services, achieve the effectiveness of monetary policies, good market practices, and high standards of corporate governance. In terms of functionality and the objectives of realizing financial intermediation, Islamic banking is not any different from conventional banking, only that the underlying structures are based on trading of assets, leasing arrangements, profit and loss sharing investments, as dictated by the Sharia principles. Now, I'll briefly take you through the principles in Islamic financing. They are interest, which is also called riba, excessive risk and uncertainty, exclusion of financing and dealing in sinful and socially irresponsible activities, and risk sharing and profit and loss sharing. So firstly, riba, which can be roughly translated as unjust or exploitative gains made in the course of trade or business. The strict interpretation means that an increment or addition above the principal amount will constitute riba, which is completely prohibited in Islam. The prohibition extends beyond interest to include the idea of unfair gain or exploitation by one party who owns a product that includes money or capital which another party wishes to acquire. The principle is derived from the fact that money is considered as a medium of exchange with no value for itself but for other commodities. Charging interest on loans is considered unjust money since it's considered to be simply an intermediary between goods. So depending on the interpretation, riba may only refer to excessive interest. However, the entire concept of interest is riba and thus unlawful. So riba contradicts the principles of profit and loss sharing, which aims to create a proper balance between the bank and customer. There are various interpretations of what contributes riba, but it's widely accepted that it's prohibited. Below are some comments from Islamic scholars on riba. Firstly, riba implies the wrongful appropriation of other people's property without justification. In other words, interest is a property right claimed outside the lawful framework of identified property rights that create a balance between the rich and poor. Secondly, riba leads to money being made from money. This is an unacceptable practice in Islamic finance. In Islam, as said earlier, money is an exchange instrument which has no intrinsic value itself. The argument is made that it's prohibited to place money in a deposit or in a bank account to gain interest without effort or without risk. According to Sharia, people should be productive and useful, but not only by investing their money, but also using it for useful trade and economic enterprise. Finally, the most essential reason for the prohibition of riba is that it is unfair in that the customer must pay interest and repay the capital, as well as bearing any losses from the use of these funds. It constitutes a form of double charging, that is, charging for both the funds and the use of funds, and for that reason, it is prohibited. Secondly, to take you through profit sharing, it's a distinctive feature of Islamic finance, social responsibility, and participation banking in general. Islamic finance is commonly referred to as participation finance, and it's believed to hold more economic potential as it focuses on cash poor businesses rather than conventional collateral based lending, which favors the established businesses. Islamic finance is based on people investing their money profitably without injustice to either customer or bank. In that respect, banks and customers should share the profits or losses from the shared investment. The reason for profit sharing is to distribute in equal measure the risk of their business proportionate to the capital contributed to the project. This means in Islamic finance, fixed income capital is not acceptable. Investors take equity positions in all business ventures financed. The owners of funds provides capital to an entrepreneur who provides experience and effort as a working partner. However, they only share the profits of the business. In the case of a loss, the owner of the funds bears the risk of the loss, and the entrepreneur loses their effort and time. It's noteworthy to point out that taking security is permitted by those who interpret it as a safeguard against negligence, willful wrongdoing, or flagrant breach of contract. Thirdly, I'll take you through Garar, as it's called in Arabic. This is an associated word with uncertainty, deception, and risk. In particular, over the existence of the subject matter of sale. It's generally prohibited under Islam as there are strict rules in Islamic finance against transactions that are highly uncertain or that may cause any injustice or deceit to any of the parties. It can be a contract for sale or purchase that includes uncertainty in the genus, species, quantity of the object, price, time of payment for the deferred sales, existence and identity of the object. Therefore, when entering into a contract, there must be full disclosure by the parties. Practically occurs where the purchaser does not know what he has bought and the seller does not know what he has sold. It's the sale of probable items whose existence or characteristics are not certain. This excessive risk makes the trade similar to gambling and as such is prohibited. In an uncertain world of financial and commercial transactions, it's becoming increasingly difficult to establish how one can take economic initiatives that can be completely free of uncertainty. It's important to note that it's not the uncertainty on its own, but where excessive risk or uncertainty is combined by one party taking advantage of another, or one party benefiting from the other's loss. The clearest example of an uncertain transaction that we have observed are derivative transactions such as forwards, futures, and options, as well as short selling and speculation. In Islamic finance, most derivative contracts are forbidden and considered invalid because of the uncertainty involved in the future delivery of the underlying asset. Fourthly, Sharia disapproves of investments in forbidden business sectors that may be deemed unethical or immoral. These can be limited to casinos, alcohol production, pork production, but neither individual nor institutions that can trade or finance enterprises can deal in these. In the next part of these trainings, my colleagues Nafisa and Nicole will take you through the types of Islamic finance contracts, most notably Musharaka and Mudarabaha contracts that are most commonly used here in Kenya. Thank you.